Good afternoon. My name is Michael Yan. I'm a wealth portfolio manager at Westwood. Joining us today, we have Alissa Howard, client portfolio manager from RBC Emerging Markets Equity, along with Adrian Helfert, chief investment officer of Westwood Wealth Management. With the geopolitical risks and tariffs dominating the news headlines, we're going to delve into the latest market trends and share insights on the outlook for emerging market investments. Adrian, turn it over to you.
Great. Thanks, Mike. Alissa, thanks for joining us. I know I personally am very interested to hear what you have to say, given we've seen such gyrations and shifts. Just to start, I'd like to hear from you. Well, number one, why invest in emerging markets? And then why invest in emerging markets right now?
Yeah, absolutely. No, and it's been quite the wild ride the past few weeks, and emerging markets absolutely haven't been spared from the volatility. But if we think about the asset class on a bit longer term of basis, it's always been a pretty good diversifier when we're thinking about balancing out a U.S. equity dominated portfolio. I'd say over the past 10 years, that's been a bit challenged. The asset class has been underperforming developed markets on a relative basis. And that's really been driven by a number of factors that we feel are actually set to reverse going forward. We feel a bit that we might be kind of at the bottom when it comes to emerging market underperformance versus developed markets, and in particular in the US. Really what drives emerging market performance is the fact that a majority of global growth is really concentrated in emerging markets. About 70% of GDP growth over the next 5 years is estimated to come from emerging markets. In the past, it's been very much dominated by China, but the opportunity set is very much diversifying across other countries and other regions. India, for an example, has essentially doubled its weight in the index over the past 5 years. There's opportunities in Southeast Asia, and we're starting to see a really good political turn in Latin America that will really help boost growth going forward. What we're also seeing is that earnings growth at a fundamental point of view are also improving. Emerging market corporates are reporting a lot better earnings, stronger margins, all those types of things that are really drive the corporates to perform better. But what's really been holding back the asset class in particular and in more recent periods has been the US dollar. We're also starting to see the tides change with that. A strong US dollar tends to be a very large headwind for emerging markets. And what we've seen is a US dollar bull market over the past 10 years. We're starting to see the US dollar weaken, and that will be a very strong catalyst for emerging market equity outperformance going forward.
Great, thank you. Can you just give me briefly, why is it that you think a weaker US dollar would help emerging markets?
Yeah, emerging market equities tend to be positively correlated with local currency appreciation. So it's very different than the US and developed markets, but those are very, it's a real tailwind for equities. And that's really been one of the bigger things that's held them back. And it also is a big determinant in terms of their debt levels, where they have US denominated debt, which is lower than it's been in history. But I'd say overall, having a weaker US dollar will also help from that perspective.
Okay, great, thank you. And just in terms of your philosophy and your process in investing, we've selected you and we're honored to have you as a manager of ours. How would you describe to our investors here your philosophy in managing emerging markets, and then the process that you employ in selecting stocks and then investing in those?
Yeah, absolutely. So we are very much a high quality strategy and portfolio. You really want to be investing in the 50 highest quality stocks in the asset class. We're very long-term in nature, and we look for companies that have a very strong management. We meet with management, we engage with management on an ongoing basis. We look for companies that have very strong and durable business practices. So management thinking long-term, investing in infrastructure and research and development, investing in its employees. And we also look for companies that have a very strong franchise, one that can really retain its market share and really grow its market share over the long term. As a result, we tend to prefer industries that have a bit higher barriers to entry so that those competitive advantages can continue, but we also really have to emphasize the quality of the returns at a company. So we're not necessarily going to be investing in the fastest growing companies. We want to be investing in companies that are growing at a stable and profitable rate. And what we found with that is that the types of companies that we tend to have in our portfolio tend to be very resilient. So they tend to have strong downside protection because they are not only profitable, but they have strong balance sheets. They have management that's navigated various business cycles, that has a lot of experience. So that downside protection has definitely been a hallmark of our strategy, but it's also led to us to have a lower volatility of return. So it's not us seeking that out, but the types of companies that we invest in being very high quality tends to lead to that result. And in terms of our process, a majority of our time, our performance and our risk is really coming from stock selection. So the team spends a vast majority of their time looking at companies, engaging again with management, thinking really long term about these companies and how they will grow going forward. The other part of our process, which is incredibly important, is that we do use long-term themes in our portfolio as well. So we have themes in areas like domestic consumption, financialization, digitalization, health and wellness, and green infrastructure. And what that helps us do is really focus our research on areas of long-term structural growth. And it helps us get away from some of the constraints of the benchmark, more declining industries, and again, really helps focus a portfolio in areas of long-term growth.
Great. You answered some of my questions I was coming up with next on the themes. Of those themes, that's very interesting to us. Any specific themes that you're overweighting now or have a higher weighting than usual on that you find important given the prevalent atmosphere, or any positioning that you would want to call out now?
Yeah, absolutely. So if you look at our positioning since we launched in 2010, we've always had a strong structural overweight in domestic sectors like consumer staples as well as financials. That's still the case today. But looking at the markets going forward and a lot of the uncertainty that we're seeing around trade wars and tariffs, I think that's really only going to reinforce our positioning in those more domestic sectors. Again, it helps us be a bit more resilient when the geopolitical risk is higher, but it's really focusing on the domestic growth of these companies, of these countries, and less on trade and those sorts of tensions that can get in the way by being more concentrated in exporters. So it's not changing our position, but maybe more reinforcing that. Where we're seeing opportunities to reduce our weighting would probably be within the information technology sector. That's an area that we tend to flex a little bit more, but going forward, we think that that might be a more challenged area. So we'll probably start to trim back on strength in the market, again, to really reinforce more of those domestic sectors over the IT sector.
Great. And how do you think about geopolitical changes that we've seen? Certainly, we're seeing political changes at country levels, and then that leads to geopolitical risk rising in different regions and different countries. Is that something you consider in your investment outlook?
Yes, absolutely. So while we want a majority of our risk and performance to be coming from company-specific risk, in emerging markets, you can't ignore the macro or the geopolitical risk. So that's always been incorporated when we're looking at various companies in our portfolio. And we're very happy to take a zero weighting in a country or even a sector if we don't think that it is appropriate for our portfolio due to something like geopolitical risk. So over the years, we've excluded countries like Russia. We started excluding Russia in 2017, 2018 because of the geopolitical risk we saw with a leader like Putin and what that could kind of lead to down the road, but also his interference at the state-owned enterprise level. That's kind of a risk that you see in emerging markets as well. I'd say when it comes to countries like China, that's an area that we've typically been structurally underweight. And it's not necessarily due to geopolitical risk. I think we take into account more longer term concerns around domestic growth, domestic politics as well in China. So that's tend to lend us to a more structural underweight, typically around 5 or 6%. We're not there right now, but that's kind of how we would take in the longer term macro and the geopolitical risk into the portfolio. I'd say when we tend to incorporate country views, it tends to be at the extreme. And so an example like Russia, an example like China, those would be kind of more the extreme ends of the spectrum.
Okay. So I assume that means that as you're analyzing individual stocks and securities, companies, you're also analyzing the economics of individual countries you're looking at for stability, for debt load, et cetera. Is that part of your analysis?
Yes, absolutely. And it's definitely part of our kind of longer term analysis and kind of where we see the opportunities going forward. So I think maybe a good example there is that there's a lot of companies that we really like in Turkey, but kind of longer term, their politics has been quite messy. Their
Yeah.
monetary policy has been anything but orthodox. And so that really prevents us from investing in those companies. And that's how we can kind of incorporate more of that top down into our company selection.
Okay. And then actually that's a very good example, just given the gyrations in their currency. How do you manage currency risk in your portfolio?
Yeah, absolutely. And I'd say, again, it's a bit more on the extremes. We don't hedge currency risk. Like I mentioned, equities and currencies tend to be positively correlated. So you're kind of giving up some of that return in upmarket periods, and it's also very expensive. But when we do take into account currencies, is again more on the extremes. So at the beginning of last year, for example, the Mexican peso was extremely expensive. We were going into elections, and that was an opportunity for us to trim back some of our exposure. Despite our long-term view on Mexico being very positive, when we see an extreme at either the top end or the bottom end, we know that there tends to be some level of mean reversion, and that may lead us to trim or add to a position.
Great. And then just in terms of today, there's a multitude of issues that we could, I'm sure, spend hours talking about. You mentioned a little bit of tariffs, and so just any further context for us on what the current environment and the tariff issues that we're seeing in primarily in the U.S. market now, what that means for you and how your team has changed its thinking, and then how does that affect supply chains and trade relationships for what are generally export-driven nations?
Yeah, it's been a pretty wild ride. I think what's maybe unique about how we approach the markets is because we are so long term. We haven't really changed much because we haven't settled on anything yet in terms of the tariffs. I think it was surprising to see how broad-based the tariffs were, but we were prepared for a Trump administration that uses tariffs as a negotiating tactic. Did we expect them to be at the levels that they presented them at? No. But what we do know is that Trump likes to negotiate. He wants to make a deal. It will be a very bumpy road to get there, but we're already seeing some kind of give outside of China tariffs. So we'll see where we end up there. But when it comes to our exposure, I think we tend to be less exposed to the exporters in these countries. We can't be completely insulated from that, of course, but by being a bit more focused on domestic sectors, on things like banks and insurance companies, where there's just this underpenetration of capital markets, that's the kind of plays that we would prefer over the exporters. So a country like Mexico, where we first saw tariffs being talked about, again, that kind of surprised us. We thought it'd be China first. Our holdings there are only in consumer staples. And so there, of course, could be an implication to domestic growth, but we aren't directly exposed to the tariffs via those exporters. And that's always been the case for us. And that, again, has allowed us to navigate some of the geopolitics a bit better. I'd say where we're thinking most on, of course, is on China. China is still the largest market in emerging markets in the index in our portfolio. We haven't changed our positioning because, again, we're a bit more domestic focused, but we are definitely waiting on adding any new names to the portfolio until there's more clarity. There's a couple of names that we've been looking at for the past few months that we really like, particularly now. The valuation is incredibly attractive with the recent sell-off, but until we have more clarity, because it's so binary, we're kind of more in a holding pattern. But again, because we're in these very high quality stocks, it's a great place to kind of hold out and wait until we have a bit more clarity.
Good answer. And then just thinking about value versus growth, I know you were talking about tech and then consumer staples. Do you think about factor risk in emerging markets as well, and how you're allocated towards the value and the growth paradigms?
We don't, especially when we look at our factor risk over the long term, there isn't really a clear sort of, if you look at it between growth and value, there's no real clear bias. The only real style bias that we've consistently been exposed to is low volatility, which is the result of our kind of high quality exposure in the portfolio. I'd say, when you're looking at allocating to a strategy like ours, it's very much a core strategy. that tends to have a bit more of a growth bias than a value bias. But I think what's important about our portfolio, because it's so quality focused, it can be a bit more expensive because we're paying up for these higher quality companies. So I'd say the team is very disciplined when it comes to valuation and trimming on highs, adding on lows, and really trying to make sure that whatever's in the portfolio, even if we want to own it in perpetuity, we're not overpaying for it.
Yeah. And I want to go back real quick. You mentioned about the state-owned enterprises, those and things, what we call quasi-sovereigns. I assume you're invested in those as well. Do you look at that partition in a country of where you want to be involved with something that close in proximity to state opining, the quasi-sovereigns and the state-owned enterprises, or is it just true corporates?
Absolutely. So we do try to avoid quasi-sovereign companies where almost wholesale. We do have exposure. We actually have exposure to a couple in China, but they really have to have a private culture. They have to have a strong management. They still have to have corporate governance. And where we'll accept that kind of risk of being aligned with the government is where the government's really kind of long-term aligned in different initiatives, be it green infrastructure, be it the property sector, something like that, where the government's really sort of stimulating. That's where we'll be more comfortable. But I'd say in general, we tend to avoid state-owned enterprises pretty wholesalely because the corporate governance does tend to be quite weak, and they don't have the same incentives that you see in the private sector to really retain or kind of have a strong management or a strong culture, or even have kind of the strong returns over time. So I think by using our themes, that also helps us to get away from some of those quasi-sovereign state-owned enterprises. And sometimes those are the companies that do quite well because they're pretty stable in terms of not a lot of people are buying and selling them. So sometimes they do well, but for us, we haven't changed our philosophy around avoiding them where possible.
Okay, good answer. We're pretty quick. I really appreciate your insight. If you just leave us with 3 to 4 things that are important differentiation points for what you do and why emerging markets are a good investment, could you just summarize for us in 3 quick points?
Yeah, absolutely. I think investing in emerging markets, it's been a difficult space over the past 10 years, but I do think we're really on a point where emerging markets could really take off in terms of their performance versus more US or domestic markets. We're seeing that in emerging markets and in terms of the tariffs and implications, intra-EM trade is at all-time highs. Emerging markets are less exposed to the US than they have been in the past. Even China, in terms of their exports, have come down from 20% of their exports down to 13%. So it's a lot more resilient of an asset class than it's been in the past. They don't have the same debt overhangs that developed markets have. And they're really, at this point, valuations are, again, kind of at the all-time low at the asset class level. So we're really at this kind of precipice when we start to see the US dollar depreciate and continue to depreciate, that emerging markets should really be able to benefit from that. And by investing in an active manager with this really strong focus on quality, you're able to navigate all sorts of market environments. You're not waiting for a certain style to be in favor, and you're also able to have this lower volatility of returns in a somewhat riskier asset class by being focused more on the highest quality companies that we think are going to be successful over the next 10, 20, or even 30 years.
Great. We really appreciate your time. We know you take time out of what are moving markets every single day. We look forward to continued partnership with you, and we hope this was informative for our investors.
All right. Well, thank you very much. Really appreciate the opportunity.
Thank you.